Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Welcome back to Bloomberg Quint. Back to earnings. It's been a stellar June quarter for Elgi Equipment with margins expanding to 9.5% this time around. What were the key factors at play? Let's go across to the management. Joining us now is the Managing Director, Jairam Varadharaj. Thank you, Mr. Jairam, for speaking to Bloomberg Quint. It's been a good quarter for you this time around. If you're looking at the year-on-year numbers, growth has been rather good this time around. But the numbers, if you compare it to last quarter, there has been a dip. Is this due to a seasonality factor, or are we seeing any kind of other reason why you're seeing a sequential drop this time around?
Well, typically in the first quarter of the following year is not going to match the last quarter of the previous year because it's normally a graded growth in any given year. So that's normal. So even if you look at the prior years, the first quarter is always lower than the last Q4 of the previous year. In terms of performance during the quarter, like you said, it's been very good. Part of it is also because last year the first quarter was impacted by the expected introduction of GST from the 1st of July. So there was a bit of sandbagging of the business in the first quarter. Even discounting for that effect, I think our performance in this quarter has been well. So our bottom line growth, which has been pretty strong, has really come from the support of the top line, and we've been able to maintain most of our costs in control.
So if you're looking at the margins for the first quarter, they were slightly below the 10% mark. But if you see the trend currently, your margins have been capped pretty much at close to 12%. What are the plans and what is the strategy that you have in place, to make these margins go beyond these 12% mark?
Can you explain to me which is the margin that you're looking at? Which profit margin?
So the EBITDA margin.
The EBITDA. Well, for us, the EBITDA is going to be a function of leverage, volume leverage. We have multiple initiatives, not only in India, but in the rest of the world, to grow the top line. And we are very confident that will happen because we're beginning to see very strong traction for our products and our brand worldwide. So once we get that, and you've seen the benefit of the leverage in the first quarter compared to the first quarter of last year. Once we are able to gain that traction and grow the top line, our EBITDA margins should automatically become quite healthy.
So, but by when do you see that number coming in much higher? So in short, what's your reason and strategy to grow the revenues going ahead?
Well, in India, we have very specific programs that we have worked over the last 2 years. We implemented them and we are beginning to see the results. And now we are rolling those initiatives across various product categories. And the results have been pretty impressive. So that's an ongoing exercise. Recently we acquired Pulfords in Australia. That's going to give us a very strong platform to grow in the Australian market. Our growth in Europe and in America has been quite significant, and we are creating specific initiatives in America in September, October to further our share of the market. So those initiatives are going to come in. But of course, there are costs involved to these initiatives as well. So to answer your question, when can we see a significant bump up in our EBITDA? I think it'll be a year from now. But even between now and that year, I expect progressive increase in EBITDA, but a transformational change in EBITDA will happen probably a year later.
Okay, so there are two main businesses that you operate in. Let's talk about the first one, and that is the air compressor market, sir. How are you seeing this market, and what are the triggers going for growth in this market, sir?
The air compressor is a capital equipment. So to that extent, when capacities are being created in various economies, then there is a demand play for our products. Now, if you look at India, what we are beginning to see is all the capacities that were generated, built up about 5-6 years ago, which have been languishing, are now have been used up, and customers are coming back into the market to build capacities, which is a good trigger for us in terms of our demand. If you look at Europe after the financial meltdown, Europe took a lot longer than the US, and now the European markets are coming back up. There is also capacity creation that's happening there. US, of course, has been growing phenomenally. The expectation of a 4% growth in an economy of that size is really significant, and that is also caused by capacities being built in that country as well. So across the three geographies which are strategic focus for us, there is significant capacity creation activities that are going on, which are good triggers for our demand as well.
Okay, the other business that you've reported is the automotive equipment markets. How do you see traction here, sir?
Well, the automotive equipment business is a very India-centric business, and it relies on the growth of not only the two-wheeler and the four-wheeler and the commercial vehicle segments, but also the plans of all the OEs in these businesses to expand their service network. So our demand trigger comes from the growth in the service infrastructure of these three verticals, which is two-wheelers, four-wheelers, and commercial. There was significant creation of service capacity last year, and therefore we grew on the back of that. There has been a bit of a lull in the first quarter this year in relation to our expectation. We have definitely done better than last year, but nowhere near what we thought we will do. So we are being a little cautious for the rest of the year in terms of whether the OEs will fulfill their planned increase in their service network. So it's a bit of a mixed bag on that business right now.
So the other factor is that, no doubt you have a lot of marquee investors that have, invested in your company, but the promoter stake is not the highest. It's rather low than compared to, what we've seen. Are the promoters looking to up the stake in the company?
I don't think the promoters have the kind of cash flow that is required to increase their stake, so I don't think there is any significant program to increase their holding at this point in time.
Okay, you spoke about the Australian acquisition and how that will benefit you. Can you be a little more specific in terms of what kind of synergies are you looking to get in from this business, sir?
Well, to just give you a background, Australia, in terms of the size of the market, is about 60 to 70% the size of India. In terms of the compressor market, it's a good market for us because the Australian customer doesn't carry a bias against products from Asia. As long as the brand delivers on its promise of good quality products and service support when required, they're quite open to considering, and we have seen the impact of that over the last couple of years, where we've grown the organic sales in Australia has grown quite significantly. Now with Pulfords, who have been selling our products for the last 1 year, we have established not only for the top management of Pulfords, but also all the employees of Pulfords, we have established credibility of Elgi as a high quality product, competitively priced, with very good support from the company for customers. So Pulfords is directly present in three of the major geographical areas of Australia. They've got a reseller network which goes beyond this major area. So, and they have the talent in both in sales and service that spans these geographies. So, association with Pulford's through this acquisition automatically gives LG an access to this very robust sales and service platform. So we will use this to grow our sales, but we will also expand that platform into other adjacent geographies of Australia, either directly or through creating a distribution network. So it's a very strong platform that we have acquired.
Okay, my last two questions, sir. What are the plans to go debt-free? You have a little bit of debt on your books. Are there any plans to go debt-free?
Well, if we are not going to grow in a very transformational way, then reducing debt is the most logical thing to do. We were on track towards reducing our debt in September of this year to become debt free. We had extended it to March of next year. But we made some strategic investments in inventory, which will shift that date beyond March. In the interim, we have also taken on debt for this acquisition of Pulford. So it's a very dynamic thing. So without the Pulford's acquisition, we think by September of September of 19, we should be able to eliminate our debt without the Pulford.
Okay, and so my final question is, can you leave us with the guidance for the balance of the year in terms of your top line, bottom line, and what kind of margins, EBITDA margins, are you looking to achieve?
I don't want to give any specific percentages, but I think the trend that you're seeing in the first quarter, we expect it to continue in the balance 3 quarters, both in the top line and the bottom line. Specifically with respect to EBITDA, I expect incremental improvement over the next 3 quarters. Nothing transformational, like I said. The transformational growth in EBITDA will come when our transformational sales increase is going to happen, which is probably a year away.
Okay, sir, we'll leave it at that. Thank you so much for speaking to Bloomberg Quint, and all the best for the quarters going ahead.
Thank you so much.
Thank you. Well, that was the management of Elgi Equipments with the details of the quarter gone by in terms of the acquisition, synergies, and growth outlook. But Agam, we also have the management of Cosmo Films that released their numbers post the market hours on Friday. What do we have?
Well, thanks for that, Darshan. Of course, Cosmo Films did report a mixed set of numbers for the June quarter. And to give us a fine print of the earnings for the quarter gone by, joining us on the phone line at this point in time is the Chief Executive Officer, Pankaj Poddar. Mr. Poddar, good morning, and thank you so much for joining us. Can you tell me a little more about the ongoings of this quarter and what has led? We have seen substantial increase in your top line, just a little bit of contraction in margins. So let me just start off with the growth as far as this quarter is concerned. What are the factors that are driving growth?
Yeah, hi, very good morning to all the viewers. So there are largely 3 reasons for increase in the revenue numbers. The first is the 5% volume growth that we had in this quarter versus the last year. The second is the favorable sales mix, as we are continuously shifting our volumes to specialty volumes. And the third is that, because of the crude oil prices, the raw material prices have gone up, and accordingly our sales revenue have also gone up because part of this has been passed on to the consumers.
Okay, Mr. Poddar, then can you tell me a little more about how you see development of input costs as we move into, say, the next couple of quarters, and what that can mean to your margins as we go in?
Yes, so I think the raw material prices should remain at the similar level. If at all, it should come down slightly, because the oil prices are expected to come down a little bit. Though it's anybody's guess. And, obviously oil prices are accordingly raw material prices are normally passed on to the consumers. So I think it should marginally as a percentage, they should look better. The other thing it should improve is certainly the working capital for us.
All right, Mr. Poddar, I was looking at your presentation and there are some concerns when it comes to your return ratios, case in point, return on equity as well as return on capital employed, which have come off to a certain extent for this year. Can you tell me a little more about whether or not we can expect improvement in FY19 going in?
Yes, so see, the main reason it has gone down is, there are multiple lines which have come up, a significant capacity has come up in last 2 years across the industry, and therefore there is somewhat excess supply than demand. Now, the good news is that, for next 2 years, this should be more demand positive than supply positive. And therefore, we should see an improvement in the margins. Right now, for last 2 years or let's say last 8 quarters, the margins continue to fall on the commodity. In fact, on most of the commodity today, recovering the overhead itself is becoming a challenge. What we are able to show the return on capital employed is largely because of the favorable sales mix or the continuous improvement that we had in the specialty. So as far as the company is concerned, I think as we move on, there will be 2 things which will happen for us. One is the specialty mix, which is already at 40%, should continue to go up. And second is the demand-supply dynamics should improve, and therefore the commodity margin should also improve. So we see a very positive numbers as we move along.
Okay, finally, Mr. Poddar, a word on your debt, and we have seen an uptick there as well. 1, are you comfortable with these debt levels? 2, are we likely to see a reduction in debt levels as we move into the financial year? If not, can you tell me a little more about the kind of mix that you are paying in terms of interest rates at the various levels of debt that you hold at this point in time?
Yeah, so our debt is around 700 crores, and we expect some reduction within this year because right now we are keeping tight on the overall capital expenditure in the company. The debt has gone up because of substantial rise in raw material cost, as I said earlier, and therefore that also contributed to increase in debt over and above the last year's significant capital expenditure that we did. So as we move along, the debt should continue to come down while the EBITDA should rise. And therefore, right now also we are in a comfortable zone, and as we move along, we should see a further improvement in our debt-EBITDA ratios.
Okay, Mr. Poddar, we'll leave it at that. Thank you so much for joining us and taking us through the quarter's numbers as well as the outlook.
Thank you.
And with that, it's a wrap in this special earnings coverage. But for more news and updates, stay tuned in Bloomberg Quint Live.